Hi, Elizabeth and William. Great to see you again. As you know, we gathered all necessary information and have constructed a comprehensive financial plan for you. Today, I'd like to review some of those recommendations. To begin with, let's discuss the education goals for Lisa and Blake. As you mentioned, you would like to have $25,000 per year per child in inflation adjusted dollars accumulated by the time each child's first year of college. We would recommend that you put away $10,372 a year away for Blake and $8,915 a year away for Lisa to achieve that goal. We would also recommend that you use a 529 savings investment account to put away money for the kids' college education. Now, this account is a tax advantage program that offers tax-free earnings on growth and tax-free withdrawals as long as they are used to pay for qualified higher education costs. Please note that there is a 10% penalty tax if the funds withdrawn from the 529 account are not used for higher education. Now, in regards to your sister, Elizabeth, Joanne, who mentioned that she was going to use her inheritance to help fund the kids' college education. Now, if this actually is the case, we would not have to be putting any money away for the kids' education because Joanne would be fully funding it. Now, we would recommend Joanne to put away $70,583 in a lump sum today for Blake's college education and a lump sum of $66,751 away for Lisa's education. Now, let's discuss the mortgage debt. As you indicated, you would like to pay off the debt in the next 20 years. In order for that to be accomplished, we would recommend to increase your monthly payment to $1,849. We looked at possibly refinancing the mortgage, but the 15-year refinance mortgage wouldn't make sense considering that we are trying to pay it off in 20 years. So we would not recommend refinancing. Let's talk about the retirement goals. William and Elizabeth, you indicated that you would like to retire on or before the age of 67, which gives us 32 years to accumulate your retirement funds. In addition, you mentioned that you have a life expectancy to live till you're 92, which gives us 25 years from the start of your retirement. We would recommend that you put away $29,219 a year to have your retirement fully funded by the time that you are 67 years old. We would also recommend William maximizes his 401k to put away more savings than he already is to help reach some of those additional retirement funds that we need to be saving each year. Currently, your retirement savings is short $12,219. So by William increasing his 401k, this is one way that we can increase that savings. Elizabeth had questions about which retirement fund would make most sense for her, and we would recommend that she opens a SEP IRA. Now, why we recommend this is that she is allowed to put in more retirement money than a similar solo 401k or simple IRA. For this reason, it makes most sense for her to set up a SEP IRA. We would also recommend that she maximizes her contributions to the SEP IRA yearly, which will be about 25% of her net earnings from her self-employment income. Now, using all of these additional saving strategies for your retirement, you will be going over the $12,219 per year um, marker that we need to increase the savings to have your retirement fully funded by 67. So by potentially saving more money for your retirement, we'll be able to possibly retire earlier than 67, which is something as throughout the life of our relationship that we'll be monitoring. And as we're getting closer to retirement, we'll say, you guys can retire, at age 60 or 65 and possibly not 67. Now let's talk about your emergency fund. As you mentioned, you would like to have a 6-month emergency fund. Now, to do this calculation, we looked at your total annual outflows, but did not include the FICA, federal, and state taxes that wouldn't be included, and also we didn't include the 401k contribution. So looking at the annual outflows minus those two outflow expenses, we understand that the total outflows yearly would be about $126,471, which would be $10,539 a month. So if we multiply that by 6, then we would say you would need a fund of $62,000 for your 6-month emergency cash fund. Now, Elizabeth, you had some questions about your online business. You're currently operating as a sole proprietorship. We would recommend that you change this to a limited liability company. Why this makes sense is because the limited liability of the one owner business not only protects your personal assets in case something happens, but also that is something that the sole proprietorship isn't currently doing. So in case you sell one of your items and there's some sort of issue, they can only come after the business obligations and not your personal assets. And as you're currently set up as the sole proprietorship, if they can go after your personal assets, which we do not want to leave them at risk as they are currently, and we'd want to set up as a limited liability company. Now, let's talk about your investments. You mentioned that you consider yourself moderate to high risk investors. After looking at your portfolio that you guys made up together, we think that it's a good start. 80% of the S&P index, we think it definitely, as the majority portion of your investment strategy, is a higher risk investment, which seems to match what you're looking to achieve. Although we would recommend a different strategy. We believe in using mutual funds who have active managers, and we also like to use allocations when we're deciding the appropriate amount of risk that we need for our clients' time horizon and objectives. So, in regards to your retirement plans, we would use an 80-20 allocation and 80% equities, 20% fixed income, and we would use mutual funds to achieve this allocation. Many studies show that 90% of your return in your investment comes directly from the allocation. Now, how we pick the mutual funds is we use top fund managers at top fund families who are rated in Morningstar and Barron's reports, also who have strong 10-year numbers of annualized return, and also we look for funds with a lot of money so we can understand that they're not incubator funds and that these are strong funds that people are using on an ongoing basis and have done a really good job in up and down markets. Um, so for your retirement accounts, we'd recommend an 80-20, 80% equity, 20% income, fixed income allocation. And also with that, as you get closer to retirement, we'd reallocate that model to take less risk because as you get closer to retirement, we want to be more conservative to not, in case of any big downturns in the market. Now, in regards to the investment funds for the education accounts, we would recommend using the age-weighted 529 investment funds. Now, these funds are specifically designed for college savings. The age-weighted 529 funds we would recommend are well diversified with an active manager who's not only moving the fund around to react to market volatility, but also reallocating the fund to be more conservative as their initial enrollment date approaches. Now, in regards to some short-term intermediate investments, which in the case we have extra money left over from your inheritance, Elizabeth, we would want to be more conservative because this would be money that we would use as backup to your cash reserves. So we wouldn't want to take a lot of risk with this money. With these assets, we would recommend an allocation of 40% equities and 60% fixed income. William, you had a question about your coin collection. You were looking to understand the tax consequences if you were to sell it. Well, the tax consequences for selling your coin collection you would have to pay long-term capital gains. In addition, you had a question about buying a 10-year bond with a 3% coupon rate. And your question was what would happen if that coupon rate were to go to 4% in the next 2 years. Well, that would decrease the value of your bond from $1,000 to $918. So we would not recommend investing in the bond with the proceeds from the coin collection, and we would recommend, if you do sell the coin collection, to use the proceeds to put in your short-term investment account. We believe we will achieve a better return by using the mutual funds, and we will not take any sort of big interest rate risk as much as you would be exposing yourself to by using the bonds. Now, let's talk about your insurance coverage. William has elected $50,000 of group life insurance through the hospital. We believe and we would recommend that you need more coverage than this. So, we use the needs analysis method. So we include a funeral expense of $25,000. We also assume a dependent income, which if something were to happen to Elizabeth, something would happen to you or Elizabeth, that you would need $1,172,935, which will give you an income up until the point you retire. Now, we got this number by we look at the income that you need right now. We're looking at your annual outflows, and we're taking out the 401k contributions, the mortgage payments, the auto loan, and the education loan. So if we take out those numbers, the annual outflows you need is $109,000 and $109,150 per year. Now, we multiply that number times 11 because that'll be when Lisa turns 16. At that point, the Social Security spousal benefit which you will be receiving will end. Now, we take that number, the $1.2 million and $650, and subtract it by $246,015, which will be 75% of William's Social Security. Now, we use William's Social Security because it's higher, and we would like to have, overestimate the protection we need. So if William's annual Social Security spousal benefit will pay $246,000 over that 11-year period, we subtracted from the $1.2 million that we will need because Social Security will be covering a portion of that. So the income that will be needed for this period of time will be $954,635. Now this lump sum of money is only showing what we're going to need from the time William passes, assuming it's tomorrow, until Lisa turns 16, because that is when the Social Security benefits stop. So there's still going to be 2 more years of income that we need to account for because we want to have that income funded until she's 18. So we're going to add back another $109,150 of the current income to the $954,635 which is the assets we'll need up until she's 16, and which will give us a total of $1,172,935 of dependent income that we would want to have covered. In addition, we included the Social Security blackout period, which we estimated you would need about $100,000 to cover you from that period. And we also included your retirement needs, which if you look in the retirement section that we discussed, you need about $371,559, which would cover your retirement period of age 67 to age 92. Lastly, we would also like to include your total liabilities, which is $319,000. Now, if we add up all these numbers, you will need an estimated $1,988,494 per person, which we would round to $2 million per person that you each should be insured up to. We would recommend using a 30-year life insurance policy. At the end of the 30 years, you guys should be self-insured by that point. We would also recommend that you have the option to convert the term policy into a permanent policy at any point in time during the life of the insurance policy. Now let's discuss your health insurance. William has the preferred provider organization plan that is offered to him through work. Now, one of your concerns was that you wanted to find out if you could get any tax advantages for paying for Lisa's speech therapist. Now, William's health plan offers a flexible spending savings account, which we would recommend that William participates in. Through this plan, William can pay up to $2,250 of pre-tax dollars, which can be used for a qualified medical expense. So we would highly recommend that you start funding the flexible spending account, which will give you some tax advantages for paying for Lisa's speech therapist. Now, we understand that you would like to use the current speech therapist that Lisa works with, but considering it's not covered under the group plan, you have 2 options. You can either pay an additional fee to continue to use your preferred therapist, or you can find a good therapist that's offered through the PPO network. Now let's discuss your estate planning needs. We would first recommend that all of your investment accounts are titled correctly, starting with William's 401k. We want to make sure the beneficiaries are up to date. Along with any accounts we set up together, we would also go through all the beneficiaries so they are up to date. Then we would recommend for you to meet with an attorney, so you can have a will put together for you guys. Now, in this will, you'll need to choose an executor who will see that your estate is settled as you wish, and also the assets go to all the correct places. In addition to that, we will also want to set up a trust to avoid probate in case something happens to both of you. So the assets will be moved there, and the trustee of the trust, who you will also assign, who can also be the same person as the executor, make sure that the assets are released to the children as you would see fit. Also important, and one of your concerns, if something happens to you, that we would need to decide a guardian for the minors. Now, this is something you'd want to discuss with them before including in the will, so they understand their responsibility. And this would want to be somebody who you trust and, would raise the kids as you would see fit. Now, lastly, I would like to discuss the inheritance that you are receiving, Elizabeth. And this could affect the plan in a couple different ways depending on how we choose to implement the inheritance. Now, when receiving $500,000, we would recommend first to pay off the mortgage and the current student loan. By paying off the mortgage especially, we will be saving several hundred thousands of dollars by not paying that extra interest over the next 20 years. In addition, we understand that the student loan has a high interest rate also, so we would like to get that paid off. In addition, in regards to your emergency fund of 6 months that you would like to have in a liquid asset, we would recommend using the inheritance money to fund the emergency fund as well. Now, in regards to your SEP IRA, which we are setting up, we would recommend that you fund last year and this year's maximum contribution. Now, any leftover funds from the inheritance, we would like to put into a joint conservative investment account. Now, allocation-wise, we would recommend, as we've spoken before, about a 40% equity, 60% fixed income mixture, which will give us exposure to the markets and also protection, so we're not going to be as risky or as volatile as the S&P might be. In addition, some of these conservative cash reserves can be used in case Joanne, for some reason, doesn't want to help fund the kids' education as she spoke about. We could use some of that money to put in, start funding the kids' college education. Elizabeth and William, I look forward to a long relationship together. As you know, this is really the foundation of our financial financial time together, of our financial road together, of keeping you on track to reaching your goals and objectives. And as time goes on, I'll be by your side to update the plan with any personal changes or market changes. And I look forward to a long relationship together. Take care.